Yesterday afternoon, $160 just vanished from the price of an ounce of gold.
Yeah, just completely evaporated.
In the time it takes to watch a feature-length movie.
Yeah.
90 minutes. I mean, that is not a standard market correction.
No, not at all. That is a structural liquidation.
Exactly. We went from this landscape of steady, confident accumulation straight into a vertical cliff dive. It left the entire market scrambling for a floor.
It was a brutal reminder, honestly, of how quickly liquidity can just dry up when that safe haven premium disappears that violently.
It changes everything.
Right. It fundamentally alters the psychology of the market. The expectation of continuous growth has been shattered.
Yeah.
We are now staring at a highly sensitive, intensely reactive environment. Welcome to your morning gold and silver market news for today, June 18th. We are decoding a near vertical drop in precious metals that has honestly fundamentally changed the landscape of the market overnight.
Absolutely. The whole paradigm shifted.
Right. And before we find out exactly what triggered this historic wipeout and, what it means for your personal investment strategy moving forward, please take a moment right now to like this video, subscribe to the channel, and comment below with your own opinions.
It really helps us out.
It does. We always want to bring you the fastest, most reliable daily updates, and your engagement makes that possible. So joining the deep dive today to help us unpack this extreme volatility is senior market analyst Michael Anderson.
Great to be here.
We have a straightforward mission today. We need to figure out how a market that looks so incredibly stable could crack so violently and basically map out the exact mechanisms driving this new era of extreme sensitivity.
Because it is a new era,
Yeah.
right? It is a critical morning to be looking at the charts. That is for certain.
Definitely.
The underlying machinery of the market is flashing a very clear warning that the previous period of, continuous rapid growth has officially paused. The easy, predictable climb is over.
So the training wheels are off.
Exactly. We are now in an environment where major institutional players are highly reactive. I mean, they're reevaluating their positions second by second.
And that reactivity gave everyone quite a shock yesterday afternoon. We're not just talking about a minor, everyday correction here. Let's look at the raw data of what exactly happened in the trading floor because the numbers are just staggering.
They really are.
Yesterday afternoon, gold was sitting comfortably around $4,380 an ounce. The trend looked solid, and then, the floor just gave way.
Completely collapsed.
It plummeted all the way down to $4,220.
Yeah, wiping out $160 in an hour and a half. That is a violent move for any asset, let alone one that is traditionally viewed as the ultimate bedrock of stability.
Right, gold is supposed to be the safe bet.
Exactly. And when you watch a drop like that on the institutional screens, you are not just seeing people actively deciding to sell. You are seeing a mechanical cascade.
What do you mean by mechanical? Like algorithms?
Precisely. What happens is that algorithms and traders have automatic sell orders, which are called stop losses, placed just below the current price to protect their profits.
Okay.
So when the price dips and hits the first layer of those stop losses, it triggers automatic selling, which of course pushes the price down further.
Which then triggers the next layer.
Exactly. It becomes a massive domino effect. The bids just completely dry up and the price falls into a void.
It's like being on a commercial airplane that hits sudden, severe turbulence. The plane just drops, then it levels out, but everyone on board is still white-knuckling their armrests.
That is a perfect way to describe it.
The market is in that exact state right now. Everyone is just waiting for trend confirmation before they unbuckle their seatbelts. Because I'm looking at the chart for the evening session, and we did see a bit of a recovery after that initial freefall.
We did, yeah.
It bounced back up to around $4,330, but looking at it this morning, it didn't hold. It is fluctuating weekly around the $4,270 to $4,285 mark. So why didn't that evening recovery stick?
Well, because it lacked fundamental conviction. We call that a dead cat bounce in market terminology.
For dead cat bounce. Right?
Yeah, it's a bit grim, but it's accurate. When an asset drops that far, that fast, you will always get short-term speculators jumping in to buy the dip, hoping for a quick profit.
Just trying to catch the bottom.
Right. But the long-term capital, the massive institutional funds, they did not step back in with any real force. The buying pressure simply wasn't strong enough to hold that altitude.
So the big money stayed out.
Exactly.
Yeah.
Every time the price tried to push higher, strong profit-taking pressure emerged from traders who were just relieved to get out of their positions without taking a loss.
Yeah.
It is keeping the price firmly suppressed right now.
Wow. And if we look at silver, the narrative is even more extreme. Silver moved in perfect synchronization with gold, but the violence of the move was significantly amplified.
Much more volatile.
Right. In that exact same 90-minute window, silver dropped from $71.50 down to $67. I mean, that is a massive $4.50 drop.
It's huge for silver.
It tried to claw its way back to nearly $69.80, but as of this morning, it has settled all the way back down around $68.30 to $68.50.
So the key takeaway for you, the listener, when watching these two metals move together like this, is understanding how safe haven funds operate under severe stress.
How so?
Well, when panic hits the system, massive institutional funds still heavily favor gold over silver to protect their wealth. Silver showed a massive withdrawal of short-term speculative sentiment.
So people dumped the silver much faster.
Yeah, they did. What we are seeing now across both metals is the market entering a distinct phase of adjustment, cleaning, and revaluation. The weak hands, meaning the traders who were over-leveraged or just hoping for a quick ride, they're being cleaned out of the market entirely.
Adjusted and cleaned out. Okay, let's unpack this a bit more because I have to admit I'm looking at my notes on the macroeconomic triggers for this, and I am genuinely confused by the market's reaction.
It is a bit counterintuitive at first glance.
It really is. If we trace this panic back to Washington, to the United States Federal Reserve, the data seems completely contradictory. The Federal Reserve kept interest rates completely unchanged at their latest meeting. They did not raise them. So if the cost of borrowing money didn't actually go up, why on earth did the market panic and sell off gold as if rates had been hiked?
That catches a lot of investors off guard, and it is a crucial trap to avoid. The trap is looking at what the Federal Reserve did today rather than what they signaled for tomorrow.
Ah, the forward guidance.
Exactly. Financial markets are forward-looking machines. They never trade on the present reality. They trade on the mathematical probability of what will happen, 6 to 9 months from now.
Right.
And while they did not raise rates yesterday, they released their economic projections. Out of the 19 Federal Reserve members who vote on policy, 9 of them predicted that an interest rate hike might still be necessary in the near future.
Wow, 9 out of 19. So it's not the actual policy itself, it's the anticipation of the policy.
Yes.
And the chairman of the Federal Reserve didn't exactly step in to soften that blow during his press conference, did he? He took a decidedly hawkish stance, essentially keeping the Federal Reserve's claws out and signaling that high rates are here to stay for as long as it takes to fight inflation.
He was very firm on that.
He made no commitments to cutting rates, stating everything depends on upcoming inflation and employment data.
Right. And that hawkish signal acts as a trigger for a massive global chain reaction. The moment the market realizes high interest rates are sticking around, the United States dollar index, which measures the strength of the dollar against a basket of other major world currencies like the euro and the yen, that index surged to 100.71 points.
Okay, let's break down the mechanics of that for a second because it's important. Gold is priced globally in United States dollars.
Correct.
So if I'm a massive fund manager sitting in Japan or Europe and I want to buy 1,000 ounces of gold, a surging United States dollar means I have to spend significantly more of my local currency just to buy the exact same amount of gold I was looking at yesterday.
Exact.
The strong dollar literally acts like an invisible tax on the rest of the world, making gold just way too expensive to aggressively accumulate.
That is the first part of the squeeze. It just crushes global demand. But the second part of that chain reaction involves the bond market, specifically the United States 10-year Treasury bonds.
The yields.
Right. Because the Federal Reserve signaled they're keeping rates high, the yield, which is the interest paid out by those 10-year bonds, remained stubbornly high, sitting at 4.452%.
I was thinking about this dynamic last night, and choosing between gold and bonds right now feels exactly like choosing between buying a Picasso painting or an apartment building.
Oh, I like that analogy.
Right. The Picasso, which is our gold in this scenario, is beautiful, it has historical value, and it protects your wealth from inflation, but it just sits in a vault. It pays you absolute zero interest.
Right, it doesn't generate cash flow.
Exactly. But the apartment building, which is the 10-year bond, might not be as glamorous, but it is currently offering a guaranteed 4.5% rent check every single year, backed by the United States government. When the rent is that high, It makes total sense that major funds would sell their paintings to buy apartments.
That is an incredibly accurate way to picture the exact mathematical calculation happening on Wall Street right now. The opportunity cost of holding a zero-yield asset, like gold, becomes deeply painful when bond yields are that high.
They just can't justify holding it.
No, they can't. Investors pull their capital out of the vault and move it into those interest-bearing assets. So Washington squeezed gold from two sides. The strong dollar made it incredibly expensive for the world to buy, and the high bond yields made it deeply unattractive for institutions to hold.
That double punch is the mechanical reason $160 vanished in 90 minutes.
That is the core of it, yes.
But here's where it gets really interesting. Washington is squeezing gold's price from one side by making it expensive and unattractive to hold. Usually when that happens, gold investors rely on global instability, the fear factor, basically, to keep prices afloat. But yesterday, that safety net vanished too, specifically because of what happened in the Middle East.
Yes, the geopolitical landscape provided the second major shock to the system.
Tell us about that.
Well, the market received news that the United States and Iran have reached a temporary framework agreement. It's called a Memorandum of Understanding.
Right, and just to be clear for everyone, this is not some permanent historic peace treaty. But the immediate goal of this Memorandum of Understanding is to extend a ceasefire and, crucially for the markets, to reopen and secure the Strait of Hormuz.
Which is massive.
It is. Now, for anyone who doesn't track global shipping logistics, the Strait of Hormuz is essentially the global economy's jugular vein. It is one of the most critical choke points in the entire world for crude oil shipments.
And the mere hint that this specific shipping lane would be secure caused an immediate aggressive reaction in the energy sector. I mean, we saw oil prices drop by nearly 3% almost instantly.
3% is a big move for oil.
Very big. The global benchmark, Brent crude, cooled all the way down to $79.14 per barrel. The American benchmark, West Texas Intermediate, dropped down to $75.35 per barrel.
Okay, I want to connect these dots carefully. We have a temporary peace agreement in a specific region, which leads to lower oil prices. How does a 3% drop in oil specifically reach across the global economy and drag gold prices down with it? Walk us through that inflation pipeline.
It all comes down to how inflation is actually measured and created in the real world. Oil is the foundational cost for absolutely everything in the modern economy.
Because it moves everything.
Exactly. It powers the container ships that move electronics across the Pacific. It fuels the trucks that deliver groceries to your local store. It is heavily used in the manufacturing of plastics and fertilizers. If the price of a barrel of oil falls, the cost to manufacture goods falls, the cost to transport those goods falls, and ultimately, the prices consumers pay at the checkout counter fall.
So lower oil prices immediately translate to lower expectations for future inflation.
Precisely. And if a market believes inflation is going to fall naturally because energy is getting cheaper, then there is significantly less pressure on the Federal Reserve to keep interest rates sky high.
Right.
Now, in the long term, lower interest rates are wonderful for gold. But in the immediate short-term panic of yesterday afternoon, a psychological factor took over. It was the complete evaporation of the fear premium.
Right, because when you have active conflict and boiling tensions in the Middle East, investors hoard gold because they are terrified of a global economic breakdown. It is the ultimate safe haven asset when things go wrong.
Absolutely.
But a secured Strait of Hormuz and cheaper oil signals stability. When the massive institutional funds feel safe, they don't want their money sitting in a defensive asset like gold. They pull their capital out of the safe haven and push it aggressively back into riskier assets like the stock market, hoping to chase higher returns.
It was essentially a perfect storm against precious metals. You had the Federal Reserve signaling high rates, you had the United States dollar surging, you had bond yields staying elevated, and suddenly a localized peace agreement breaks out, dropping oil prices and completely removing the fear that was driving people to hold gold in the first place.
It's amazing when you lay it out like that. But amidst all this downward pressure, there is a fascinating silver lining that we need to address.
Yes, there is.
Despite taking a sledgehammer from the bond market, the dollar, and the oil market all at the exact same time, gold did not crash completely. The floor didn't give out. It stopped falling at $4,220. What exactly caught it? I mean, why didn't it just keep sliding down to $3,000?
That is perhaps the most important and encouraging piece of data from the entire session. The floor did not collapse because of a massive wall of underlying physical demand.
Physical demand?
Yes. While Western speculators and exchange-traded funds were frantically selling off their paper gold contracts on the digital markets, buyers in Asia and global central banks were quietly stepping in to buy the actual physical metal.
Oh, wow. So while the algorithms were panicking, the central banks were accumulating.
Yes. Global central banks are accumulating gold for long-term strategic reserves to diversify away from the United States dollar. They do not care about a 90-minute drop or a hawkish comment from a Federal Reserve member.
They're playing a much longer game.
Exactly. They view these sudden price drops simply as a discount. It's a buying opportunity to acquire physical tons of gold at a cheaper price. That underlying physical demand is acting as a massive structural safety net for the entire market.
That makes perfect sense for gold, but it brings me back to silver. Why was silver's drop so much more violent? Why didn't it have that same structural safety net catching it?
Because silver has a completely different fundamental identity. It has a dual personality in the market.
Right, it's not just a precious metal.
Exactly. It is heavily tied to gold's movements, yes, but it is also a vital industrial metal. It is deeply integrated into the manufacturing of electronics, solar panels, and electric vehicles.
Okay, so it responds to manufacturing data too.
Very much so. So when the market gets worried that the Federal Reserve is going to keep interest rates high, which traditionally slows down economic growth, and manufacturing silver gets hit twice.
Double whammy.
Yeah. It loses its appeal as a precious metal because of the strong dollar, and it loses its fundamental value as an industrial metal because a slowing economy means less manufacturing demand. It is inherently more vulnerable to these complex economic cycles than gold is.
That clears up so much. So we have thoroughly mapped the turbulence. We have looked at the massive macroeconomic engines driving the market, from Washington to the Middle East. But what does this actually mean for you listening right now?
That's the real question.
Exactly.
Yeah.
How should you be looking at your own portfolio this morning? I don't want us to just offer generic advice like, be patient. What are the actual actionable mechanics you should be applying to your strategy today?
Right. Well, the very first step is separating the short-term noise from the long-term reality. In the short term, day trading in this specific environment is highly unfavorable.
Too risky.
Incredibly risky. The trend is completely unclear right now. The market is whipping back and forth based on sudden headline news and technical stop-loss orders being triggered. Unless you are a highly experienced institutional trader with complex risk management software, trying to day trade this specific volatility will likely result in severe capital loss.
So step away from the intraday charts. What about the long-term perspective?
The long-term outlook is fundamentally stable. The overarching multi-year upward trend for gold has not been broken by this specific drop.
Good to know.
Yeah. The primary variables dictating the future remain the United States Federal Reserve's actual rate decisions, the trajectory of oil prices, and the broader geopolitical landscape. But given the massive central bank physical demand we just detailed, the mathematical likelihood of gold breaking deeply below the $4,000 mark is currently very low. The foundation is solid.
Okay, so if the long-term trend is still intact, what are the strict strategic rules you should be using to navigate this current storm?
There are 3 critical rules you need to prioritize right now. Rule number 1, absolutely do not chase strong rallies.
Don't let the fear of missing out take over.
Exactly. When you see the price suddenly jump up $50 in an hour, do not let that emotion force you to buy at the local top. The market is highly reactive and throwing head fakes.
And rule number 2.
Prioritize waiting for actual mathematical trend confirmation before committing new capital.
What does that look like in practice?
Trend confirmation does not mean a gut feeling that the bleeding has stopped. It means waiting for the market to establish a clear direction. For instance, look for 2 consecutive daily closes above the $4,300 mark. A daily close shows that the capital stayed in the market overnight rather than just whipping around during intraday trading.
That makes a lot of sense.
And if your strategy is long-term accumulation, if you are steadily building a position over years, prioritize buying near the $4,200 zone. That level demonstrated massive institutional support yesterday.
And rule number 3, regarding the actual cash you have sitting on the sidelines ready to deploy.
This is a crucial mechanical warning. You must divide your capital. Do not disperse all your investment funds in a single trading session.
So don't just dump it all in at once.
Never. If you have $10,000 you want to invest, deploy $2,000 now near that support zone. Wait to see how the market reacts to the next major inflation report and then deploy another portion.
averaging your cost into the market over time rather than trying to perfectly snipe the bottom.
Exactly. In a market this sensitive, strict risk management is infinitely more important than trying to perfectly predict the absolute peaks and troughs. You will rarely, if ever, catch the exact bottom of a crash.
Right.
But by dividing your capital into tranches, you protect yourself from catastrophic losses if the market suddenly triggers another cascade of stop losses and takes another dive.
That is the kind of practical, actionable insight you need right now. So to bring all of this complex machinery together and provide a concise recap for you, we have just witnessed one of the most volatile trading sessions in recent history. A perfect storm of Federal Reserve signaling, a surging United States dollar index, stubbornly high 10-year Treasury bond yields, and sudden shifts in Middle East shipping lanes created a massive synchronized sell-off.
It was a textbook cascade.
It really was. But while the short-term sensitivity to these macroeconomic triggers is at an absolute high, the long-term upward trend holds firm, mostly supported by that massive central bank buying of physical metal.
The landscape has fundamentally changed, though. We are no longer in a market that just climbs effortlessly.
No, we're not.
We are in a market that demands careful attention to the underlying data and incredibly strict risk management.
Which leaves us with a lingering, somewhat provocative question to ponder as we watch the charts today. Think about this. If a mere forward-looking projection from a few Federal Reserve members can evaporate $160 from gold in 90 minutes, what will happen to the market when actual physical macroeconomic shifts occur?
That is the big unknown.
Right. If the anticipation of a policy is causing this much destruction, what happens when the policy actually changes? Are we entering a financial era where the psychological anticipation of an event matters far more than the event itself? It is something you definitely want to keep in mind the next time you see sudden turbulence hitting the markets.
Definitely something to watch.
Thank you so much for joining our deep dive today. We wish you good health and, as always, successful and safe investments. If you found this deep dive helpful and want to stay ahead of these massive, complex market moves, please don't forget to like this video, subscribe to the channel, and turn on notifications so you never miss our daily updates. We will see you next time.